Welcome again to Wealthee. Today I am going to talk about share imputation. You may have heard of share imputation. It refers to a tax system in Australia that avoids double taxation on company profits, which are distributed as dividends. So in Australia, when a company pays dividends, so the income that they pay out on your share ownership, they also pass on what's called a franking credit. So that credit represents the tax that the company has already paid on those profits before they pass the dividend on to the shareholder. So shareholders can use those credits to offset their own tax liability. So here's an example. So say a company, let's say it's a Commonwealth Bank, pays a $70 dividend to a shareholder. They will attach to that a $30 franking credit. So that $30 franking credit represents the 30% corporate tax which has already been paid. So the shareholder will actually declare the $70 dividend plus the $30 franking credit as their income from that share. So that's $100 in income that they have to declare for tax purposes. Now, if the shareholder's tax rate is 30%, then they won't have to have actually paid any tax on that $70 because the company tax rate's 30 cents and their own tax rate is 30 cents. There's no double taxation, so they get the full $70. If their tax rate is lower than 30% or 30 cents in the dollar, then they'll get a refund of the unused portion of the franking credit. And if their tax rate is higher, then they'll pay the difference between the 30% and their own tax rate. It's a pretty generous system, and it's one of the reasons why investing in shares, investing in companies, can be a good idea. As always, make sure you get your own advice, and we'll see you next time.